Welcome to today's edition of the Statler Financial Radio Show. Your financial security is our business. Have a question for the team? Call today, 863-877-1188. That's 863-877-1188.
Welcome to the Statler Financial Radio Show with founder and president of Statler Financial Services, Philip Statler. He is with us today. He has been in the financial services industry for over 2 decades, and Philip is a lifelong resident of Sebring. Folks from Sebring and the surrounding areas have questions about retirement, all kinds of questions, and we call it our Statler Financial Mailbag segment. Philip, does that sound a little outdated when you call it mailbag?
Yeah, I don't know. I mean, I get mostly junk mail in my mailbox anymore for sure. And hey, my wife and I were actually talking about that this weekend that we actually, 2026 is my actually 25th year.
That's amazing.
In this business. Yeah.
Congratulations.
Yeah. So that was.
So are you guys
start thinking about that?
Doing anything special at the firm?
No, not right. It just actually, we just kind of just thought of it the other day when we started counting back. Somebody was asking me. And so when I started counting back, I thought, oh no, 2001 is when I kind of made this my sole path for the most part. So yeah.
And it probably seems like yesterday in some
in some respects, yes.
All right, are you ready for the mailbag, Philip?
Yay, we can always get ready for some mailbag questions. I always like to answer questions.
There you go. Our first question is from Stacy in Sebring today. She says, my husband and I are both taking Social Security, and next year we'll have to start taking required minimum distributions from our IRAs. Could those withdrawals cause more of our Social Security to be taxed? That word tax we all love, right, Philip?
Oh, yeah, we do.
That's a good question.
And the answer, it is a good question because the answer has multiple choice answers, right? Because it depends. And everybody loves that answer, right? What do you mean it depends? Well, it's not a black and white answer, right? Yes, it could cause your taxes to increase on your Social Security, but then it may not. If you have a pension, your husband has a pension, you may already be maxed out, right, on your taxability of your Social Security. So here's the deal. Social Security, the max of that it can be taxed is up to 85%. So, you have 20 grand of Social Security, then 17,000 of it could be taxable. And that's the max. You can't go any higher than that. That ends up being taxable. So, however, if the amount you're paying on your Social Security is less than that, then yes, your required minimum distribution adds to the formula that determines how much of your Social Security ends up being taxable. And that's why a lot of times we encourage folks to try earlier in their retirement years to start converting some of their IRA money to Roths. Because substantially, we're going to probably end up in a higher tax bracket now that we're taking our RMDs, our required minimum distribution. So the short answer is for you, I don't know, but typically, yes, it is going to make more of your Social Security taxed.
All right. Very good. Let's go to Jeff in Lake Placid. I want to retire next year at 62, but my wife plans to keep working until at least 67. How do couples build an income strategy when one person is retired and the other is still earning a paycheck?
Well, Jeff, it's no different than if both of them quit working, right? I just have more income to work with for a little while until the wife decides to stop working. Now, I have to make a couple of assumptions that you're both the same age, because otherwise it doesn't really work out. Now, if there's a bigger age gap or an age gap there, then that can make a difference. I was having a conversation actually with my sister not too long ago, and we're doing some retirement planning for her. And, she's like, well, I think I want to retire at 62. And her husband's, I think about 8 years older than she is. And he's actually already retired. And so, how do you do that? Well, you have to sit down and put together a plan. And actually for them, because of health insurance, which is typically the reason why, we've looked and we ran the numbers at 62 and said, yeah, It would work, but it wouldn't be fun. It wouldn't be exciting. We wouldn't be able to do things we want to do. So maybe we have to push out to 65 because then Medicare kicks in and then we don't have to worry about health insurance at that point in time. Yes, we still have to pay our Medicare premiums. We have to pay our Medicare supplemental insurance. We still have to pay those things, but it would reduce our overall what we would normally have to pay in health insurance. And that's I think that's the key takeaway here is that as we look at retirement planning, income planning specifically, when you retire makes a difference. Not just because it's Social Security and the timeline of Social Security, but because of the healthcare issues. And so that's why we take the time and the energy and the effort to get people on the same page to put together a written retirement income plan that they can actually see, feel, touch, and know, hey, look, this makes sense to me. Here's why I do need to work another year or two. And don't put it off. I mean, Stephanie, I think some people, when I say that, that raises the fear level. Oh, I'm going to see Philip and he's going to tell me I got to work 3 more years and I don't want to hear that. Well, folks, listen, it's better to hear it now.
Sure.
Than you decide to do everything and then all of a sudden you start running really short. You're real tight. You have to go back to work because you can't make ends meet. Don't be that person. Okay. Pick up the phone and give us a call and let's start the process. It's simple. It's a phone call and that number to call is 863-877-1188 is 863-877-1188. I'd love to sit down with you and make sure that you are on the right path to the retirement you always dreamed of.
And Philip, I bet your sister loves having you as her financial advisor.
Sometimes not.
Only when you tell her what she wants to hear, probably.
That's right.
All right, let's move on to our next question. Jack in Avon Park asks, I've managed my own investments for years, but before I retire, I'd like a second opinion. If we come in to meet with you, what do we actually need to bring? Do we need every account statement right away? Or can that come later? And that is a great question. I know a lot of people are wondering what they need to bring into you on that first visit.
It is a great question, Stephanie. And so it depends. How much do you want us to start to look at things now, or do you want to wait till later, right? We need the statements to do all our analysis. And so statements, tax returns, what your Social Security is going to look like in increments. So typically you can get your Social Security statement at ssa.gov and you can pull a statement and it'll tell you, here's what you'll get at 62, here's what you'll get at 67, here's what you get at 70. And based on those numbers, our software, and it's pretty daggum good, will get you, okay, if I decide to retire at 65, boom, here's how much I would be entitled to as my Social Security benefit. So we need that. If you get pensions, we need to know what your pension money is going to be when you decide to retire. All those type of things. Anything that's going to contribute to your retirement, income or expense-wise, I'm going to relocate. I'm going to sell my house and I'm going to buy a more expensive house. Well, we kind of need to know that. I'm going to downsize. We need to know that. Those are the things that we have to know to be able to put these things together and make sure that you've got everything the way it needs to be.
You are listening to the Statler Financial Radio Show, and Amy in Sebring wants to know, between the two of us, we have several old 401ks and a couple of traditional IRAs. We'd like to simplify things before retirement. Are there any tax issues or common mistakes we should watch out for if we start moving those accounts around?
As long as you don't touch the money, and it doesn't go into your bank account, it goes directly from custodian to custodian, then you should be okay. The issue is going to be if you actually say, cut me a check or deposit that money into my account. That's going to be an issue, right? Because now you've taken possession of money that was retirement money. And so there are some very, very specific rules. You're only allowed to do that once in a 12-month period of time. You got 60 days to put it back into another retirement account. So there are some very stringent rules. And if you miss that rule by one day, it will cost you big time.
Wow. Government is
when you
strict.
It is very strict. And it used to be, we thought we could do that on a per account basis. But the Supreme Court ruled that what the law says is you're allowed one only IRA rollover per year. Meaning, when I say rollover, it means you actually touch the money yourself and roll it to an IRA. They call that a 60-day rollover. You're allowed one of those in totality every 12 months. So we are, our firm, we don't want to do it. We do not want anybody doing a 60-day rollover. It has to be a very extreme circumstances for that to be the way we do something. Otherwise, we want to go custodian to custodian, 401k directly to your IRA, IRA directly to your IRA, Roth to Roth, whatever it is. We want it to go custodian to custodian. We don't want anybody in the middle to touch the money.
Good to know. All right.
Yep.
Well, if you'd like to give Philip a call, Statler Financial, you could call him at 863-877-1188. That's 863-877-1188, or you could go to statlerfinancial.com. We have about a minute left. If they call, make that visit, that first appointment, what can they expect when they come in, Philip?
So we're going to go through their statements. We're going to look at their income. We're going to look at what they think their expenses are going to be at retirement, what their income is going to be at retirement. Look at their Social Security statements, make sure they have those so that we can run some numbers, because that's the only way we can really build a detailed income plan for folks. And that's really the key is having something in writing that you can gauge every year, right? Am I on track? Let's pull it out this year and see. Here's how much I have saved. Here's where I'm at. If I retired today, this is where I'll be. Still projected out 5 years. This is what it looks like. So those are the things that we want to make sure we have in place. And it's easy. Like you said, they just have to give us a call at 863-877-1188 to get started.
All right. Thank you, Philip. And you are listening to the Statler Financial Radio Show, and we will be right back. Turn your plans of yesterday into yes today. Don't wait another day for a routine checkup of your retirement plans. Call Statler Financial Services, 863-285-3815. That's 863-285-3815.
Happy 250th birthday, America. You don't look a day over 120. Oof. Kind of sounded better in my head. Anyway, happy Independence Day, America.
Many people don't plan for long-term care until they have to. But long-term care isn't just nursing homes. It can include in-home care, assisted living, or ongoing support over time, and those costs often aren't covered by Medicare. That's why Statler Financial Services helps clients plan ahead, looking at how long-term care fits into a broader retirement strategy. Planning ahead is not about expecting the worst. It's about understanding your options. Call Philip Statler at Statler Financial Services today at 863-877-1188. Philip and his team offer guidance to clarify your choices and cost before you need to act, no matter what life brings. Now is the time to learn more. Call Statler Financial at 863-877-1188, or you can text VISIT to 863-877-1188.
Advisory services offered through Second Half Financial Partners, LLC, a SEC registered investment advisor.
Welcome back to the Statler Financial Radio Show with founder and president Philip Statler. I'm Stephanie Griffin. Thank you so much for listening today. Market volatility isn't a question of if, but when But here's the truth. With the right preparation, market corrections don't have to derail your financial future. Philip, let's get started with fundamentals. Why should every investor, regardless of their age or portfolio size, have a plan in place for market volatility before it happens?
Well, I think a couple of things. One is, I think you said it just a minute ago. It's not, if it happens, it's when it happens, because we know historically it's going to happen. We just don't know when. So a couple of things that we need to make sure that we are ready when it does happen. Emotional decisions during downturns can be wealth destroyers. We saw that in 2008, where people bailed. When we call it capitulation, that's when everybody starts bailing out of the market instead of holding tight because they just can't stomach it anymore. So emotionally, you need to make sure that you've got that tied down. How much are you willing to hang in there? Corrections happen on a regular basis. Now, correction is when the market drops by 10% or more, but less than 20%. 20% or more, we start to call that a bear market. It's more than a correction. So they're going to happen on a regular basis. And so having a plan helps eliminate those panic-driven mistakes. And that's where having that retirement income plan in place, knowing where your income is going to come from, and making sure that it is a little bit more protected than the rest of your accounts goes a long way to helping you weather those storms. So preparation allows you to see opportunities too, not just the threats that come when the market declines.
And if you'd like to talk to Philip about your portfolio, you can do that by calling 863-877-1188. That's 863-877-1188. And yeah, we've seen it happen. We've all seen it happen. Investors who seem to have everything figured out suddenly make devastating mistakes when markets get rocky. So what are some of the most common and costly errors you see people make when they haven't properly prepared for market volatility?
Selling at the bottom to, quote, stop the bleeding. At that point, if you're at the bottom, you might as well ride it out. A caveat, right? As long as you've got a well-diversified portfolio. Now, if you're in all, penny stocks or something that's very, very risky, well, that's a different story. I'm talking about people that have a well-rounded, a well-balanced portfolio. Then those companies are good, solid companies. They're going to weather the storms like they have for years. So that's one. Moving everything to cash and missing the recovery. I got to tell you, I saw this last year. Stephanie, I had a client come in and say, look, I'm concerned about the election. I'm concerned about what's going to happen. I want to get out of the market. I want to go to cash.
Oh, wow.
I said, oh, okay. So I let him think about it for a little while, and I gave him a couple other scenarios. Mm-hmm. Why don't we liquidate half and leave half invested? Well, he called me back and said, no, we talked about it. We just want to liquidate everything. Let's put it in money market. Let's see what happens with the election. And what happened? The election hit, markets bounce, and it's tough to get back in to the marketplace. So just an example of where we see it happen. Abandoning your diversification. Like I said earlier, all this relies on having diversification within your accounts. And that's a big deal. And then letting fear override your long-term strategy. The younger you are, the easier this is because you got a lot of time left. The closer you get to retirement, that's why we need to start making adjustments to what our accounts look like before we get to retirement. I would say 5 years before retirement, we need to start looking at those accounts and making adjustments so that we don't have too much risk in there for retirement time.
Well, some investors think they can actually wait until they see trouble coming and then make adjustments. I don't know about you, Philip, but I don't know how to time the market. And I know that's pretty difficult. So what makes it so challenging to predict when volatility will strike or when stocks will go higher? And why is waiting until it happens such a risky strategy?
Here's the deal. Nobody knows, what the market's an emotional machine. A lot of times it's emotion that drives the market. Yes, the traders out there, the people that do this for a living, they're looking at, either charts or technical analysis or fundamental analysis or all those things. But you can throw those things out the window when emotions hit. And so we don't know when the next thing's going to happen. Right. And just because the markets are down doesn't mean the stocks in your portfolio are down. You may have stocks that are, counterproductive. They may go the other direction. So you just don't know. Just because the market's down doesn't mean your account's going down. I see that all the time. And so you just need that to make sure it comes down to those couple things, Stephanie, making sure that the risk in your portfolio overall matches up with the risk you can handle. And we saw this back in 2008, where people thought they were a moderate investor. Unfortunately, a moderate portfolio back then lost 15 to 20%. That was way more than the moderate investor thought they could lose. And so they figured out real quick they weren't really moderate investors. The problem is they found out too late. We want to find out ahead of time what kind of investor you are so that we can pick the right kind of portfolio. And that helps with that whole process.
You are listening to the Statler Financial Radio Show. You can go to his website, statlerfinancial.com, find out more about the services that they have. And you can also give them a call, 863-877-1188. Sit down with Philip, talk to him, have that free consultation, 863-877-1188. Now, Philip, you've helped a lot of clients prepare for and navigate through various market cycles. For someone watching who's thinking, I know I should prepare, but I don't know where to start, how do you help people build a comprehensive volatility preparation plan? That's a mouthful.
Well, that is a mouthful, and but it's a good point to make. And I guess really, Stephanie, it starts with understanding the amount of risk you can handle. And we've got a couple tools that we use here at Statler Financial to help us ascertain what that number is for you on a scale of 1 to 100. What does that look like for you? And so we plug that into our system and build our portfolios around that. And we can show you, look, based on your risk number, if we had another 2008, here's what it would look like for your portfolio versus what your current portfolio looks like. If another 2008 happens, here's what your current portfolio would look like. So sometimes that helps people understand what the differences are between different portfolios by, when we run those big booming situations, what could happen. And so that really helps them get a better picture of risk and how it affects their portfolio.
Since every investor has unique circumstances, risk tolerances, and goals, can you walk us through the kind of personalized volatility assessment you can provide for clients?
Absolutely. And that's really our core retirement design, Stephanie, is that process where we'll sit down with folks and make sure and actually run a risk analysis on their current portfolio to see, okay, what is the risk in that portfolio on a scale of 1 to 100? We run you through an analysis to determine what your risk score should be. And then we compare the two. If your risk number is a 52 and your current portfolio is at 75, well, there's a big mismatch there. And so we need to make sure that we get on the same page, that our portfolio and our risk tolerance are on the same page. And that's really what we strive to do here at Statler Financial.
Philip, can you walk us through the process at Statler Financial Services and tell us a little bit more about that?
Absolutely, Stephanie. So we start with a no obligation, a 30-minute phone call. That 30-minute phone call is really where you can ask us questions. We'll ask you questions. We want to see where you are and what your ultimate goals are. And if you're on the right path to get there, God bless you. We're going to let you know that, or we're going to encourage you to do a couple things and set you on your way. If I see a place where I think I can help you, I'm going to let you know that. Hey, look, I think that we could help here, or I think you're off track there. And then we would sit down together in the office and go over, or by Zoom. I can do Zoom meetings too. And we'll go over where you are and collect the data that we need, statements, tax returns, all those things to put together a financial plan for you. And by doing that, then our next step really is we get to work and we run the risk analysis on your current portfolios. We also then get what your risk assessment looks like. From there, we look at the fees and expenses you're paying inside of there. We move on to taxes. We prepare a tax plan and see, if there's any opportunity for you to be saving in the area of taxation. And when I say saving, I don't mean saving just for today, but I want to save you a lot of money over your retirement lifetime. And so sometimes, Stephanie, that means we pay a little bit more tax today and tomorrow in order to live tax-free the rest of our retirement. So that's the second leg of our planning process. The third leg is putting together that income plan, showing you where the income's going to come from, how we're going to get the income we need. And then the big number is, how much income do you have to spend? We'll come up with all of those things in the third leg of our core retirement design. So when you're done, you have a risk analysis, a tax analysis, and an income plan all put together for you, ready to go. And so that's really our core retirement design. Again, we want to help people have the retirement they always dreamed of. It's a simple phone call to get started. Give us a call at 863-877-1188. That's 863-877-1188 to schedule your 30-minute phone call. Or you can go to my website at statlerfinancial.com. There's a link there that you can click and schedule a time as well. I look forward to speaking to you soon.
And we will be right back, and we're going to be revealing specific strategies for building your volatility defense system and the critical mistakes that could leave you vulnerable when markets turn turbulent. The Statler Financial Radio Show will be right back.
Needing a second opinion on your retirement plan, or to see if you're paying more than your fair share to Uncle Sam? Schedule your complimentary visit today. Text VISIT to 863-877-1188. That's VISIT to 863-877-1188.
The market goes up, it goes down, but retirement keeps going. And when you're close to retirement, those swings can feel very different. At Statler Financial Services, our planning focuses on helping plans stay aligned through market movement, so short-term volatility doesn't disrupt your long-term plans. It's about balance, income planning, and staying disciplined through changing markets. Call or text VISIT to 863-877-1188 now for your free risk analysis from Philip Statler at Statler Financial Services. If you're nearing retirement or already there, now's the time to review your strategy. Take the first step. Get your questions answered before the next market volatility takes a chunk out of your portfolio. Call or text VISIT to 863-877-1188. That's VISIT to 863-877-1188. Advisory services offered through Second Half Financial Partners, LLC, a SEC registered investment advisor.
Welcome back. It's the Statler Financial Radio Show. Let's get into the specific strategies that can help protect your portfolio and your sense of reassurance. Philip, what does a well-structured volatility defense system actually look like? It sounds so stealth or something, I don't know. And how can it help protect investors when markets become turbulent?
Well, I think one is, your core holdings need to kind of have some stability. So you've got a core portfolio that's going to kind of be the bread and butter that's going to be there, all the time. And then we have growth positions to help combat inflation. The one thing I know is as I talk to people all the time is, well, I don't want to be in the stock market. I'm going to tell you something. When I have 90-year-olds that we have at least 10% of their portfolio is in the market. Why? Because it helps combat inflation. And we know inflation has been pretty bad here the last few years. And so this is one area that can help offset some of the inflation. And then having some protected income generation strategies. There are, dividend portfolios that you can put together that would have some specific, allow you to throw off some specific amount of income. There are annuities out there that will give you an income stream for the rest of your life. And those can be beneficial. That way you don't have to worry about the ups and downs of the market. If they go down, it doesn't matter. Your income's not going to be affected. And then the last thing I think that people, I think they know they need to do it, but they want to retire early, so they don't care. And that is, folks, you need to optimize your Social Security benefits. You really need to do the math to figure out when is the best time for you to take Social Security. I understand if health is an issue and you need to retire at 62, but there's a lot of folks out there retiring at 62 or taking their Social Security at 62 and still working, that it is not a good idea to do that. And we need to look at why it's not a good idea. And we need to look at how can we do better and protect our spouse. And there's a lot of things that go into optimizing Social Security. It's not just the dollar amount that's there when you start drawing. And those are the things that we look at and talk about when we start talking about optimizing your Social Security benefits.
Now, there is a fascinating psychological component to market volatility. How can investors prepare themselves mentally and emotionally for the inevitable stress that comes along with the market downturns?
It's hard to really, kind of get that psychological component put together, because so many people live in fear. And so when the market starts to drop, they fear creeps in and starts to really take effect, right? So I think if we look at a couple of things, one is understanding your true risk tolerance before the crisis hits. Like I said earlier, people in 2008 found out they were not moderate investors too late after their accounts were already down 15, 20%. And so understanding what your true risk tolerance is before a crisis hits is a huge deal. It really, truly affects how you should be investing your money. Other thing is maintain historical perspective on the market recoveries. I mean, if you look back, I can go back to 2000, right? One of the first major bear market I went through as an advisor. And what we have seen both in 2000 and 2008, if you had a well-balanced portfolio, well-diversified portfolio, it basically took you 4 to 6 years to get back to even. And so you need to have that perspective on market recoveries. Now, we've had some, right? The COVID bear market was a flash in the pan. It was down 30%. In 6 weeks, we were back to where we were. So it does happen that way. Corrections, we have a 20%, 10% correction, and, within a couple weeks, we can be back up. So markets recover. And then we need to have a written plan, because that will help us reduce the emotional decision-making that we're trying to do. Having that written plan that we can go back and look at is a huge deal. And then bucket planning, putting your different accounts in buckets. This is the bucket I'm going to draw from day 1 retirement until day 10 of retirement. Then I'm going to go to this bucket. So having the bucket approach can really help us plan out how we're going to use the income, and lets us put part of it, that last bucket we're not going to touch. If it has ups and downs, it doesn't really matter, because we don't plan on using that bucket anyway, except for emergencies and to to our beneficiaries. So that's part of the planning process there.
You know what, you said bucket planning. I thought we were adding to our bucket list. That's that meant. All right, let's address something that keeps many investors up at night: the fear that this time the market won't recover the way it has historically. So, Philip, how can investors balance learning from history with preparing for unprecedented events?
Well, I think that one thing, we diversify beyond traditional assets. If we look at some of the other models out there, when it comes to endowments and those type of things, how do they invest their money? They use some non-traditional assets to help when the market gets a little rough. Stress testing. I mentioned this earlier. Stress testing for various scenarios, taking your current portfolio and looking at what would have happened in 2008 if I had this current portfolio right now. Gives you some sense of okay, I can handle that, or no, I can't. We need to make changes. A big thing is this, Stephanie, you need to focus on what you can control. Tax strategies, Social Security optimizations, diversification, and then maintain flexibility to adapt. That's huge. We got to be flexible to be able to make changes. All of this wrapped up is our core retirement design. I'd love to sit down with you, talk to you about it, see if we can help you develop the retirement plan that's going to give you that retirement you always dreamed of. Give me a call at 863-877-1188, 863-877-1188.
And you can also text VISIT to that same number and contact Philip at Statler Financial Services, 863-877-1188, and get in for your complimentary visit. Now, we've covered a lot of ground today about preparing for market volatility. For listeners who are realizing they may not be as prepared as they should be, what kind of comprehensive portfolio review process do you use to address volatility vulnerabilities?
That's a lot of V's in.
There's a lot.
Yes. Again, the first component of our core retirement design is really identifying and measuring the risk you have in your current portfolio. And that's going to give us, based on that number, we will know how volatile your portfolio could be. And so from there, we have kind of that view of here's what it looks like. Here's what it would look like in 2008. What do we want to do about it? Are you comfortable here? If not, here's some suggested changes we might want to make to make sure that we're okay on that front. It's planning. If you have a plan in place and the markets are going to go up and down, or maybe they go down and up, but they're going to be volatile. And if you're ready for that and you're mentally prepared for it, then you can weather those storms. And having that plan in place is a big part of it, Stephanie.
And, every investor situation is unique. We talk about that all the time on this show. So how can you create a customized volatility preparation strategies that align with each client's specific circumstances?
You're right. Everybody comes in with a different set of assets. They all have different goals. They have different concerns about what volatility looks like in their life. And so it is, again, and I feel like a broken record sometimes. It's putting together that plan, having that plan in place that will, really allow you to invest properly, understanding the amount of risk that you need to have in your portfolio to grow, but yet the amount of risk you need to be comfortable with. And I think that's really the bottom line is getting folks comfortable with the risk. And some people honestly never get comfortable with the risk. I can't tell you, I've got several clients that will say, I don't like the market. I know you do. I don't really necessarily like the market, but it's a tool that we need to use. And they trust that we are doing what's in their best interests, which is why we're meeting with them, why we're making changes to portfolios and making sure that they're in the best possible position they can be in. And that's all part of the process. You have to meet with people. You have to assess their fears, walk them through it so they understand where they are, and let them ask questions. And the questions they ask are huge. And being able to educate them on why it's important, it is a big part of what we do. And it's part of what we like to do, is we want our clients educated about why they are in what they're in, why we're using these tools in these certain ways to get them to where they need to be. And that's what it's all about, helping people be comfortable in retirement. I'd love to help you. Give us a call at 863-877-1188. That's 863-877-1188.
And that's what I love about you at Statler Financial, Philip. You let people go in, you talk to them, you don't talk at them, you help them understand, and if they have questions, you are happy to answer them. So please give him a call for a sit-down, a free consultation, 863-877-1188. And the Statler Financial Radio Show will be right back.
Many people don't plan for long-term care until they have to. But long-term care isn't just nursing homes. It can include in-home care, assisted living, or ongoing support over time, and those costs often aren't covered by Medicare. That's why Statler Financial Services helps clients plan ahead, looking at how long-term care fits into a broader retirement strategy. Planning ahead is not about expecting the worst. It's about understanding your options. Call Philip Statler at Statler Financial Services today at 863-877-1188. Philip and his team offer guidance to clarify your choices and cost before you need to act, no matter what life brings. Now is the time to learn more. Call Statler Financial at 863-877-1188, or you can text VISIT to 863-877-1188.
Advisory services offered through Second Half Financial Partners, LLC, a SEC registered investment advisor.
Welcome back to the Statler Financial Radio Show. I'm Stephanie Griffin, and we are halfway through the year. For those of you with serious retirement savings, that makes this a critical time for financial tune-up. Not like a full overhaul, not panic, just a clear, disciplined check-in to make sure your money is still working as hard as it should be. Philip Statler, president and founder of Statler Financial Services, has put together a mid-year checklist specifically for retirees and pre-retirees with significant assets. And I want to make sure you know about the opportunity you have as a listener of the show. If you're ready to take control of your retirement and see your entire financial situation clearly, call 863-877-1188 to meet with Philip and his team at Statler Financial Services. That's 863-877-1188. Philip, walk us through it. Why does the middle of the year matter so much for people in this position?
Well, it's time to look at the plan. I would say the middle of the year, it's easier to fix small problems earlier, right? If we wait till the end of the year, it might be more difficult. Retirement plans need regular maintenance. So we have to look at where we are, look at retirement plans, look at people's 401ks. Do they need to make any changes? Those type of things. And then, life just changes and, priorities can shift very fastly. And so we want to take the opportunity in the summertime when things typically work related kind of slow down a little bit. And here in Islands County, it really slows down because, a lot of the winter people go back north. And so it's the time to catch your breath and let's see where we are and does anything need to be tweaked.
Very good. Well, for the first item on the checklist is revisiting financial goals. Now, for someone who's retired or within a few years of retiring, what should they be focused on right now?
Well, I think we need to look at several things, but income needs will change, right? I mean, it's never going to be set it and forget it. Life throws us curveballs. And sometimes our needs change when it comes to income. And so we need to look at that. We need to look at, is our cash flow sufficient? Are we coming to the edge of the month and we're right there at the edge? Well, then we need to make some adjustments, whether that's on the income side or spending goals need to be updated, right? Maybe because we've had some curveballs thrown at us, we may need to reduce our overall spending. We may need to go in and say, hey, look, we need to make some changes here, or the opposite, right? Things are going really well. You can take that big trip around the world, or, hey, you wanted to take your family on that week cruise and pay for it all. And hey, look, we've had a bumper 6 months. You can do that. Let's go ahead and schedule that. So that's another area that we look at. And then if you've not retired yet, then it's time to, okay, let's reassess where we are and what does that retirement timeline look like? Is the date we picked, is it still realistic based on where we are right now? So some things to think about halfway through the year.
All right. And your checklist, it also includes a full investment portfolio review. So what should high net worth investors be asking about their allocation right now?
Well, I think, more stocks obviously mean more risk. We continue to see that the markets are at very high valuations right now. And so you have to ask yourself, is it time to do some reallocations? Do I have too much risk in my portfolio right now based on where the markets are and how close I am to retirement? Is a big one, I think. And I think drift can happen, right? Especially in the markets we've seen now, meaning, and what does that mean? That means as the market equities go up in value, now you drift. You have a higher percentage in a certain type of stock allocation. And that's not what you originally wanted. And so that means they call that drift. We've drifted away from that point because the markets have increased in value. So we need to come back and bring those back into proper alignment.
Okay. I've always heard that term, but I never knew what it meant.
Yeah. And so that means we need to rebalance. Right. We need to rebalance to keep everything really risk intentional.
You're listening to the Statler Financial Radio Show, and you can get a hold of Philip by giving him a call at 863-877-1188. He'd love to sit down with you and have a visit. 863-877-1188. Tax-efficient strategies are also on your checklist, Philip. Why is now the right time to have that conversation?
Well, you're halfway through the year, right? So if you wait too long, then that may limit your options of what you have time to do. Some things, take longer to accomplish than others. As we look at things like Roth conversions, or if you've already retired and you're over 70 and a half, then QCDs, qualified charitable distributions. There's things like that we want to take the opportunity to start. We may not do them right now, but we want to see what the opportunity is to do them in the third quarter or partly in the first part of the fourth quarter. Mid-year gives you room to make adjustments if things aren't going well in your portfolio. Maybe we make a change or tweak something here or there. And then tax mistakes can reduce your retirement income. You need to remember that when you have big capital gains, something like that, then yes, we're going to get hit with some taxes that we may not have expected within our portfolio. If you're retired or within 10 years of retirement, folks, this is the time for mid-year tune-up. Call us today at 863-877-1188, and we'll sit down with you and we'll review your current income plan, your investment risk strategy, your tax exposure, your cash position, and your overall retirement strategy to help spot issues before they become expensive roadblocks. There's no cost, no obligation. Again, my number, 863-877-1188. That's 863-877-1188.
There is a lot to things when you retire, so give Philip a call, please, and talk to him if you have questions. 863-877-1188. That's 863-877-1188. Finally, let's talk about legacy planning. What are some of the biggest risks of letting a legacy plan go unreviewed?
If you got a will or a trust that you haven't really looked at in a while, you definitely need to pull that out, blow the dust off of it, and let's read through it to make sure that it still does what you want it to do, and make sure it's still the best vehicle to get things done. Remember this, and I had this discussion here recently with some clients whose mother passed away, and that's the beneficiaries on your accounts override your will, they override your trust, they override everything. So if you left money to a ex-spouse and you never change your beneficiaries, guess what? That ex-spouse is going to get whatever's on there. So that's why it's so important that we periodically look at our beneficiaries and make sure that they line up with how we want them to be structured. And then protection needs. The need for life insurance changes over time. Early in years, we need more life insurance to cover kids, spouses left to raise kids on their own, things like that. The older we get, hopefully, we've got enough saved in our investment accounts that the need for life insurance becomes less and less. There are some times when it still plays a vital role, especially long-term care planning. Sometimes you can get some riders and use life insurance for that planning. So there are still some times where it does become beneficial in the retirement planning process, Stephanie. As we kind of close out, I want you to think about the mid-year check-in. It's not about making drastic changes. I'd hate to have to come to a mid-year and make drastic changes. That means maybe we didn't set things up right the first time. It's more about making sure that your retirement plan is still healthy. It's still current, up to date, and it's working the way it should. So look, if you have $500,000 or $1 million or more saved, call us here at Statler Financial today for your complimentary checklist. We'll sit down with you and go through this and make sure that you've got everything the way it needs to be for your retirement plan. We'll look at your current retirement income plan to make sure it's going to do what you want it to do. We'll look at your investment allocation and risk, look at tax and contribution opportunities, evaluate your cash management strategies, review your insurance, your beneficiaries, and your estate planning documents, and see if there's any gaps there. Again, no cost, no obligation. Give us a call at 863-877-1188. That's 863-877-1188.
Very thorough. We appreciate that. Thank you, Philip. Thanks for tuning in, and we'll have more of the Statler Financial Radio Show next week. Have a great day.
Needing a second opinion on your retirement plan or to see if you're paying more than your fair share to Uncle Sam? Schedule your complimentary visit today. Text VISIT to 863-877-1188. That's VISIT to 863-877-1188.
Advisory services offered through Second Half Financial Partners, LLC, a SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Second Half Financial Partners, LLC does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation. This radio show is a paid placement.